What's up, everyone, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're talking about delta. So we're going to start getting into the option Greeks. We're going to start off with delta, which is probably the most basic to understand, and how that relates to an options price. And then tomorrow we're going to wrap that into gamma. So gamma has a direct relationship with delta, so it's going to be a nice pairing. And then we'll finish off our conversation with theta on Tuesday. We've got some other Greeks like beta and vega, but we'll get into those later. I think the big three that we want to learn about are going to be delta, gamma, and theta. So let's start off with delta and what that means with an options price. So when we're talking about delta, we're basically talking about the rate of change of an options price given a $1 increase in the underlying price. So what that basically means is that different options have different deltas, and you can see those on any order chain. So if you're in DOE, you can change the column to delta. You can view them. Whatever table you're on, whether it's the curve view or the table view, you can change that to see the delta and see how that changes for out of the money and in the money options. But the four big things we're going to talk about today with delta, and this big triangle is what you might see in math equations. So if you look into skinny on options math segments where Jacob is talking about basically big equations, we're going to see this triangle here, and that's basically what we're going to see when you're looking at delta, and you're going to see that on the trade pages as well. So we're going to talk today about traction and how that basically affects option prices. We're going to talk about directional risk, how we can use delta to hedge, and also its relation to probability of being in the money. So let's get right into it, and let's talk about traction. So when I'm talking about delta and traction, the way I like to think about it is, think of a drag racing car and think about the types of tires that are being used on that car. So if I have a low delta option, I might be throwing on Honda Civic economy tires on that drag racing car. We've got so much power, but the wheels are probably going to spin because there's not enough traction in that option. But if I have basically drag racing tires that are massive and they're gonna go with the car, I might have a high delta option. So what this basically means is with traction, the higher delta you have, the higher the option price is going to change in relation to an underlying price. So when we get down to it, positive deltas range from 0 to 1.0 when we're talking about option deltas. So when we're talking about stock deltas, you can have 100 deltas, which would be 100 shares of stock, which we'll get into later. But when we're looking at options, you're going to see that range for positive deltas between 0 and 1.0. On the flip side, negative deltas are going to be ranging from -1 to 0. And basically, all you really need to know with traction is that deltas that are closer to -1 and +1 will have more option price traction. So if we look at an example here, we can clearly see that. So we've got a $1 increase in the stock price. So if I've got an option that's a 25 delta and the stock price goes up $1, so if I have a positive 0.25 delta and the stock price goes up $1, then the option price should go up 25 cents. So basically you can think of it as like a ladder in relation to, or like stair steps in relation to the options price and the underlying price. So if I've got a $1 increase in the underlying price and I have a 25 delta, I should see a 25-cent increase on that option. Also, if I have a higher traction delta, like 85, which is going to be a pretty high delta, so if I'm looking at calls, this is going to be a deep in the money call if I'm buying that call. And for puts, it's going to be the same thing, deep in the money if I'm buying that put. But in any case, if I have an 85 delta and it's a positive delta, if I have a $1 increase in the stock price, now I should have an 85-cent increase in the option price. So you can see that it's basically traction, and the higher the delta there is, the more that option price is going to move 1 for 1 or closest to 1 for 1 with a stock price. Now, if I had an option delta here that was 1.0, then if I have a $1 increase in the underlying price, I'm going to see a $1 increase in the option price. So that's when you get super deep in the money, and basically the options are trading more like stock than options. So the next thing we're going to look at is the directional risk here. So when I'm talking about directional risk, when I say positive deltas, I would have a long market assumption. And that's because with the example we just showed, if I have underlyings increasing in price and I have positive deltas that are going to increase that price as well, then basically I have a long market assumption. So basically if I'm buying a call and I want that underlying to go up, I'm going to have positive deltas with the call. Negative deltas are going to be short the market. So it's the opposite. So if I have negative deltas and the underlying goes up, then I would be losing money in that position. But if I, for instance, buy a put or sell a call, those are going to be negative delta directional assumptions with the market. And neutral deltas or zero deltas is basically going to have a neutral market assumption. So if I have various positions on and I'm trying to keep that delta neutralized, basically if the underlying goes up or the market goes up or down and I have zero deltas, that basically means that my directional risk is going to be much less than if I had positive or negative deltas. So that's what we like to do here at tastytrade, is try and keep our deltas as neutralized as possible so that we're all about the duration instead of direction. So we're all about durational trades. So if we keep our deltas neutral, that's going to help us minimize risk to the upside or downside. So again, when I'm looking at options, if I am buying a call, that's going to have a positive delta, because at the end of the day, when I buy a call, I want the underlying to go up, because a call option gives me the right to buy 100 shares of stock. So I want that underlying to go up to be successful. And that's why the option is going to have a positive delta, because if that underlying actually does go up, I'm going to see profits if I'm buying that call. On the other side, if I'm buying a put, then I would have negative delta. And that's because buying a put gives me the right to sell 100 shares of stock. So if I buy a put at a certain level and then the stock goes down, I can now sell the shares higher than what they're worth in the marketplace. So that's going to have a negative delta. Now, if I'm looking at selling options, it's just the opposite. So if I'm buying a call, it's going to have a positive delta. And if I'm selling a call, it's going to have a negative delta. And if you just think of the transaction, if one person's buying the call and one person's selling the call, one person's going to want the stock to go up while the other is going to want the stock to go down. So when I'm selling a call, I've got a negative delta, and you'll see that reflected in the options price, as you'll see there. So with a short put, it's just the opposite of a long put. So if I'm long a put, I want the option underlying to go down. If I'm short a put, I want the underlying to go up. So that's a pretty quick way how you can visualize the options and how the options are going to have these deltas when you're trading them. So the next thing we're going to look at is going to be hedging. So let's talk about how we can hedge and how we can use deltas to hedge our positions. So we can use options to hedge stock. So this is basically what we do in maybe an IRA account, where I might be holding more stock shares than I would be in a margin account, because I don't have that additional leverage in an IRA account. So maybe I'll be trading covered calls more, or having naked stock positions and then looking to hedge those positions when I think that something might be going on in the market, or when implied volatility is high and I just want to collect that premium. I'll be looking to hedge that stock. So if we look at a couple of examples here with hedging, let's say I've got 200 shares of stock, which is going to give me 200 deltas. And that's because if I have 200 shares of stock and the underlying goes up $1, I should see a profit of $200. And that's just because I have one-for-one movement since I actually own the stock. So if I'm looking at a covered call, what I could do is hedge the position, but not fully hedge it. So this would be an under hedge. So let's say I've got 200 shares of stock and I'm looking at selling 2 out of the money calls for a negative 30 delta. And again, when I'm selling calls, it's going to have negative delta. So this is going to be me selling out of the money calls, just collecting premium to reduce my cost basis. So if I've got 2 negative 30 deltas, I've got negative 60 delta. So instead of me having all the directional risk of 200 shares or 200 delta, now I only have 140 delta. So basically, I'm collecting premium, reducing my cost basis, and I'm reducing my directional risk if the underlying does end up going down. On the other hand, I can also do a full hedge. So what's important to note is that delta changes, so that's gamma. Gamma is the change of delta, but what I can do is temporarily give myself a full hedge. Now, if the underlying goes down or up, then this delta is going to change, because the calls, or the delta that the calls actually have, is going to change as well. So if I'm looking at a full hedge of these shares, let's say I'm happy with what's going on, or maybe I've seen a pretty big spike up in the underlying and I just want to fully hedge that position. Let's say maybe I don't want to close it, but I want to collect some premium and basically offset any bounce it might have to the downside. So I might look at a full hedge. So if I'm looking at the money calls basically an at-the-money option is going to have a 50 delta. It's basically a 50-50 shot either way. So if I'm selling calls, if I'm selling 4 at-the-money calls that are 50 deltas each, then I'm basically having a negative 200 delta. So if I have positive 200 delta with my 200 shares and negative 200 delta with my short options, then I'm going to have a neutralized delta, or a delta of 0 at that point in time. So basically I'm collecting the premium, I'm reducing my cost basis, and regardless of what happens with the directional assumption of that stock, I'm basically giving myself a full hedge temporarily. So let's take a look at another thing we can use delta for, and that's going to be percent in the money. So this is a really quick way to determine what your percentage of being in the money is. So if you look at an option chain, so on Thinkorswim or Dough, you can change the columns to show you delta or probability in the money. So what you'll see is delta basically goes 1 for 1 and looks almost exactly like probability of in the money. There's going to be a few percentage points difference, but when you're looking at options, they're basically going to have the same thing. So if I'm looking at a 25 delta, it's probably going to show me a percentage of being in the money of close to 25%. So again, options delta is roughly equivalent to probability in the money. So let's look at a few examples. So if I'm looking at an out of the money option, I'm looking at a short call. So that's going to have a negative delta of 30. And if I looked at that probability of being in the money, since I'm selling an out of the money option, I'm going to have a 30% probability of being in the money. And again, when we're selling options, we want them to remain out of the money. So if I've got 30% probability of being in the money, I know that I've got a 70% chance probability of being out of the money. And a quick way we can calculate that is just by taking 100%, which is the probability, and you can subtract any number that you have. So if I have 100% and I know the probability of in the money, I can subtract the probability of being in the money from 100 to get the probability of out of the money, and vice versa. So I know if I've got a 30% probability of being in the money, I've got a 30% or 70% probability of being out of the money, and that's a high probability trade. Now, if I'm looking at the money, I've got a 50 delta here, short put. So again, it's a 50-50 shot if we're at the money. So it's going to have that 50% probability of being in the money, which is going to give me a 50% probability of being out of the money. So this really is where we're talking about maybe buying options, where you're getting that 50-50 shot if we're buying at the money options. If we're selling at the money options, we're going to still be collecting that premium. So it's going to be a little bit higher than a 50% probability of profit because we have that better break-even point. But in terms of delta, it's going to be 50-50 probability in the money or out of the money. Now, let's look at an in the money option. And this is going to show you why we don't sell in the money options. So if I'm looking at a short call that's in the money, it's going to have a higher delta than 50. And that's because if you look further out of the money with calls or puts, doesn't matter. When you're looking out of the money, it's going to have a lower delta because it's going to have a lower probability of being in the money. But the further you go in the money, it's going to have a higher delta and a higher probability of being in the money. So again, if I'm selling an option, I want that to be out of the money at expiration so it expires worthless and I can keep that entire credit. If I'm looking at a negative 60 short call, then this is going to be a 60% probability of being in the money, which is a 40% probability of being out of the money. And again, I want this to be out of the money at expiration. So if I'm trading 40% probability of being out of the money, it's going to be a low probability trade. So I wouldn't look to do this to enter a trade outright. So that's why we're selling out of the money options here at tastytrade. So let's look at a few takeaways here. So delta, again, is the rate of change of an options price given a $1 increase or decrease in the underlying price. So what's important to note is that if I want the underlying to go up, I'm going to want to have positive deltas. So I'm going to be looking at things like buying call spreads or selling puts or selling put spreads. If I want the underlying to go down, I want to have negative deltas. And I'll be looking at things like selling call spreads, buying put spreads, things like that. So if I want the underlying to go up, it's going to be positive deltas. If I want the underlying to go down, it's going to be negative deltas. And deltas signify your directional risk. So the more deltas you have, the more directional risk you have. So again, that could be a good thing or a bad thing. So if the underlying goes in your favor, then that's going to be a good thing in terms of profitability. But if it goes against you, then I'm now going to be losing more money than I would have if I was directionally neutral or had zero deltas. And another takeaway is deltas roughly equate to probability of being in the money. So it's not going to be totally accurate or completely equal, but when you're looking at deltas and probability of being in the money, they're pretty much going to be the same values. And last but not least, we can hedge our positions using delta. So if you think of one share of stock being one delta, regardless of how many shares you could have 500, 1,000, 10,000. We just have to make sure that if I'm hedging that position, I need to take account those delta shares, if I'm using stock as an example, and then figure out how many calls I would need to sell, or however many puts, or whatever option strategy I'm using to give me negative or positive deltas to offset the directional risk if that's what I'm trying to do. Pretty much directionally neutral, since we're more about duration than direction. So this has been delta. We're going to talk about gamma tomorrow. So gamma is basically a subsidy of delta. So delta is the rate of change of an options price, where gamma is the rate of change of delta. So we're going to get into that tomorrow. If you've got any questions or feedback, shoot it over to support at tastylive tastytrade. Thank you so much for watching, and until next time, this has been Mike and his whiteboard.
Hey guys, I hope you enjoyed this video.
Click below to watch more videos, subscribe to our channel, and if you want to trade along with us, visit tastytrade.com.